Investing and trading in the stock market. In this video, you're going to learn the only way to predictably and consistently make money in the stock market. And it's actually quite simple. So irrespective of how large your account size is, whether it's $2,000 or $20 million, what you should do is the following. The first thing is you need a small watch list. So you have a watch list with companies like Facebook, Amazon, Lockheed Martin, Boeing, JP Morgan, McDonald's, PayPal. Let's say you put in another industry like gaming, like TTWO, which is Take-Two Interactive. And then let's say because the market in October 2018 has been extremely volatile, you also want something which is a little bit recession-proof. So you put Dollar General, DG. All right, so this is one industry. This is two, defense. I guess JP Morgan and PayPal, they're kind of similar. I mean, PayPal is more a processor, JP Morgan's a bank, but let's just say that that's three. McDonald's is four because that's food. This is five, although I do believe that tech and gaming go hand in hand. And then six, which is a recession-proof Dollar General. So let's say we were to combine Facebook and Amazon and then gaming, so then that would be a combination. And then we already combined JP Morgan and PayPal. So instead of six, you have five. You have five industries right there. That's a tremendous amount of diversification. And those are all great companies. So irrespective of whether you have $2,000 or $20 million, you're going to create a very small watch list of market-leading stocks. All of these are market leaders. Right? Maybe Take-Two Interactive is not necessarily a market leader, ATVI or Electronic Arts, but from a performance basis, then Take-Two is definitely a leader. Then, very simply, you want to ignore everything else. When my students tell me to look at, look at United Healthcare or look at this stock or look at this, I don't even look at it. I just say, no, I don't read any articles on Seeking Alpha. I do not allow myself to be distracted. So do not get distracted by anything else. Just focus on the opportunities that are on your watch list for the simple reason that all of these opportunities behind me are A+ opportunities. There's no reason for you to look at, or also like RTN I like. So let's say in the defense you have Lockheed, Boeing, and RTN. There's no reason for you to then look at NOC. Why do it? There's no point. For JP Morgan, there's no reason for you to look at Bank of America. It's not worth it. Don't do it. It's not a market leader. For Visa, I guess you could look at, well, we don't have Visa on here, but for Dollar General, there's no reason for you to look at then Dollar Tree, DLTR. It's not worth it because it's underperforming the marketplace. Only focus on market leaders and ignore everything else. The next thing you want to do is you want to get familiar with the trading range. So Amazon right now, I think it's around like 1720. This is mid-November 2018. This past week, I sent out an alert to my subscribers because Amazon traded down to 1650. What I did was I told them to sell a put with a strike price of 1480. Then the next day, Amazon increased in price to around, it was up around $120. It traded to around 1760, 1770 before it sold off a little bit. I forget exactly where it closed. It was between around 1750 and 1760. When it was trading around 1750, I told them, remember, they're already short a put with a 1480 strike. I told them to sell a call with a strike price of 1860. They received around $5 in premium. For this 1480 put, they received, I think they actually received around like 10 bucks. Yeah, they received a lot of money on that. I'm not exactly sure how much, but what happened was when Amazon was trading around 1650, when they sold the 1480 put, the next day when Amazon traded up to 1760, they then closed out by buying back this position that they sold for $10. They then bought it back for around $2.50 for a 75% profit. Then the next day, when Amazon went up to 1760 and they sold that 1860 put, or 1860 call rather, the following 2 days, Amazon traded down to around 1700. maybe it's around 17.10. They closed out this call that they sold for $5 for around $2.20. So they profited on both ends of the extreme. And the reason is very simple, because when you get familiar with the stock's trading range, you know that when Amazon is trading at 1650, then there's a high probability that it's not going to trade down all the way to 1480, which is the price of your lower price strike. So, I mean, think about it. And then also, on the positive side, when Amazon is up over $100 in one day, when it's up over 5%, we feel very comfortable selling that 1860 call, because we know that right now prices tend to get overextended, but then there's always a reversion back to the mean. Well, I don't want to say always, because when I say always, then it automatically invalidates it. But the majority of the time, it's statistically profitable and statistically significant that there's going to be a reversion to the mean. So when Amazon falls from like 1770 to 1650 and you sell that 1480 put, you are then giving yourself over $200 of safety net. You're giving yourself around $180 rather of safety net. The difference between the 1480 strike that you sold and the 1650 current price of Amazon is $170. The difference between 1480 and 1650. As a result, you are providing yourself with $170 worth of moat, $170 worth of protection, which is over 10%. Amazon would have to fall more than 10% in order for that position to be challenged. On the call side, when Amazon goes up 5% in a day, when it increases in price by $120, and then you sell the 1860 call, you are then also providing yourself with a substantial safety net, because then Amazon would still have to appreciate over $100 and continue and extend its gains until that call position was challenged. Very similar position to Lockheed Martin. Actually, Lockheed and Raytheon have outperformed over the past week. I know that Lockheed right now, I think today is around November 10th of 2018, November 11th of 2018, don't quote me, but I think Lockheed right now is around $311 or $312. And I think just like 2 weeks ago, Lockheed was trading at around $295. So what you could do is you could wait until Lockheed Martin trades at $295, and then because volatility is very high, you can sell the $270 put, and you can receive around $2 or $3 in premium. In fact, when Lockheed Martin fell all the way down to around $290 or $295, I actually sold a $265 put, and I received around $2 or $3 worth of premium. Then, as Lockheed stabilized and it's gone up and now it's trading around $310, I closed out that position for around a 50% gain in just about 2 weeks. So I barely held on to that security, I reduced my risk, and I took my gains. So you can do this with every single stock. McDonald's right now is pretty much the outlier, because McDonald's I think hit a new high last week. So right now McDonald's I think is trading at around 186. And I mean, it shouldn't be that impressive that I can quote the stock prices or the trading ranges of all these securities. I mean, this is what I do every day, and all these stocks are on my watch list. So like I know, like, all right, Facebook, I think it's at like 146. You know, Amazon is trading around 1720. Lockheed's around 312. Boeing, I think Boeing's around like, 365. Raytheon, I think, is around 187. Etc. But you will get familiar with all of these positions and where they're trading at. Like JP Morgan is trading at around, I think, like 112. McDonald's is around like 186. PayPal's around $85. Take-Two, I think it's trading at around 112. And Dollar General is trading around 115, 116. I mean, you should be able to do that, because these are the only stocks that you're going to focus on, right? So when you log into your account like 2 or 3 times a day, you're just going to get comfortable with the relative trading range of all those stocks. So what we like to do is we primarily like to sell puts first. That's our primary objective. And then opportunistically, we will turn that position into a strangle by selling a call option. we will begin, and we have begun over the past month, to sell calls as our first entry point and as our first priority, because the market has been extremely volatile. And as the market turns and we think that we're entering more of a bear market, we will start to lead in by selling a call position, whether it's a naked call or a vertical credit spread. And that's another thing. As the market has gotten more volatile, I have begun to sell more spreads. I have begun to sell more credit spreads, more put spreads, more call spreads, to protect myself against the inherent volatility that the market has had over the past 3 months. And it has been extremely volatile. Having a 1 or 2 or 3 standard deviation move in one day is relatively commonplace now, relative to 2017, when it was extremely rare that we had the S&P trade within a range of like 1.5% on a daily basis. But 1.5%, 2% on a daily move in the S&P 500 is relatively common over the past 2 or 3 months. So as a result, we want to protect ourselves by trading verticals, by managing our size, and perhaps most importantly, by closing out the positions early. So what you do is you would take a position in any of these stocks. Like here, let's just use Take-Two Interactive, right? Because Take-Two Interactive, around 4 days ago, earlier this week, right, the second trading week in October, Take-Two Interactive was trading at around $125. Then, the day of its earnings, it was trading at around 120. It then shot up to 129, only to pretty much immediately, within the 5 minutes of the opening bell, trade all the way down to, I think, around like 112 or something. It traded down to like 112. Then the next day, it actually traded below 110 to around 108. When Take-Two Interactive was trading at around 110, volatility was extremely high because people were scared. I then sold a 95 put on Take-Two Interactive. And my reasoning for it was very simple. That just 2 weeks ago, Take-Two Interactive was trading at $135. I am completely okay with owning Take-Two Interactive, a market-leading gaming company, at $95 a share. Plus, I'm completely okay with collecting that premium because I know that this trade is going to be profitable around 95% of the time. So I sold the put on Take-Two Interactive. Take-Two has since rebounded. Currently is trading around 113. And I will end up closing out that trade for a profit this coming week. I mean, look, I can't tell the future. Maybe tomorrow the S&P drops 4% and Take-Two drops below $100, in which case I'm going to have to roll and manage that position. But there's a very high probability that, assuming that nothing outlandish happens in the stock market this week, that I'm then going to close this position. This leads me to my last point of being a consistently profitable trader. Remember, you don't want to day trade, because day traders are not They're not traders. They are fraud victims. The only way that you can be successful in the stock market consistently is by selling option premium. But I want to bring you back to something because of the volatility that we've recently experienced in the stock market. What you want to do on every single position that you open, you want to evaluate and go through your current portfolio. And for every position, ask yourself, would I make this trade right now? So, a good example, when we sold the 1480 put on Facebook and we received around $10, then when Facebook increased in price from $16.50 to $17.60 in one day, the amount of premium that we could receive if we resold and sold that 1480 put again, instead of receiving $10 or $1,000 for every contract that we sell, we can only receive $2. In my opinion, selling a naked put or even a vertical on Facebook, or rather on Amazon, and receiving $2, which is $200 for every contract you sell, is not nearly as good a risk proposition as receiving 5 times that amount of money as we did just the day before when we could receive $10 in premium when Amazon was trading at $16.50. So when I saw that position and was showing me a 70 to 80% gain in that one security, I simply asked myself, would I sell a 1480 strike on Amazon to only receive $2 worth of profit? So I asked myself again, would I sell a 1480 put on Amazon right now for $2 worth of premium? And the answer was no. So what I did was I just bought it back and I made 80% in one day. Now, is that an outlandish and a non-recurring example? Yeah, 100%. You're not going to make 80% profit in one day. It just doesn't happen. That was just completely fortunate and lucky. And because of that situation, because I felt that it is very common that a stock, one of the largest companies in the world, is not going to appreciate in value by over 5% in one day, I felt that the price was too far extended to the upside. So then we opportunistically turned that into a strangle and then sold the 1860 call and received around $5 in premium. Then over the next 2 days, as Amazon's stock price normalized and it decreased in price from around 1750, 1760 to around 1720, we then bought back that position at around $2.20 with the same principle. I looked at that position that was selling for $5 and I asked myself, would I sell an 1860 call on Amazon right now to only receive $2.20? The answer was no. I then closed it out. That's how you manage your risk. You trade small, right? And you close out your positions early. But where we differ from Option Alpha and Tasty Trade and Tasty Works is that we do not trade often. So if Tesla right now, I think is trading at around like 350, if Tesla drops to 250, I am not going to sell a 180 put on Tesla. I just ignore it. I don't even look at Tesla. I don't look at any other stocks besides the stocks that are on my watch list. I ignore everything else. I don't read articles on Seeking Alpha because you know that what you're doing when you're reading articles on Seeking Alpha, you're just looking for a confirmation bias. You are only looking for affirmation that the decision that you made was correct. You are being entertained, but your goal should not be to be entertained. Your goal should be to improve yourself, to learn a skill, and to make money. So if you want to improve yourself and you want to make money, this is how you make money consistently in the stock market. If you want to be a gambler and you want to be a fraud victim, then you can day trade. That's completely cool with me. A lot of day traders do not actually make successful option traders because day traders get this thing in their head where they believe they're going to make 300 to 500% a year, but they end up losing all their money. When you trade this strategy, you can earn from 30 to 70% every single year consistently. And that's how we make money. That's how investors invest in the stock market. And that's how investors invest in specific large cap, market leading, industry leading stocks. And that's how they make consistent profits. This is David Jaffe with beststockstrategy.com. You can go to beststockstrategy.com, enter in your email address, and receive over $400 worth of free materials, free training materials. Please like, comment, share, and subscribe. If you have any questions, I answer all comments and questions. You can leave a comment below, and I'm here to help you. Thank you.